Why liquidity is key to Forex trading success. 1. Introduction to the Forex market and liquidity. 1.1 The structure of the Forex market. The Forex market operates as a decentralized, over-the-counter, OTC, network of banks, brokers, institutions, and retail traders. Unlike centralized exchanges, for example, stock markets, Forex trading occurs electronically via interbank systems, electronic communication networks, ECNs, and broker platforms. This structure enables 24-hour trading across 4 major global sessions: Sydney, Tokyo, London, and New York. The market's participants include central banks. Entities like the Federal Reserve and European Central Bank influence liquidity through monetary policy and interventions. Commercial banks. Institutions like JP Morgan and Deutsche Bank facilitate interbank trading, accounting for over 50% of daily volume. Hedge funds and institutional investors. Large-scale players engage in speculative and hedging activities. Retail traders. Individuals accessing the market via brokers, contributing 7% of total volume. 1.2 Defining liquidity in Forex. Liquidity in Forex is measured by 3 pillars. Volume, the number of units traded within a time frame. High volume indicates active participation. Market depth, the volume of buy-sell orders at different price levels, visible in the order book. Speed of execution, how quickly orders are filled at desired prices. A liquid market features tight bid-ask spreads, for example, 0.1 pips for euro to US dollar, minimal slippage, and stable prices. In contrast, illiquid markets exhibit wide spreads, for example, 10 pips for USD/ZAR, erratic price swings, and delayed executions. 1.3 The role of major versus exotic currency pairs. Major pairs include currencies like euro to US dollar to Japanese yen, and pound sterling to US dollar, which are highly liquid due to their association with stable economies and high trading volumes. Exotic pairs, such as USD/TRY, US dollar/Turkish lira, or USD/THB, Thai baht, involve emerging market currencies with lower liquidity, higher volatility, and geopolitical risks. 2. The mechanics of liquidity provision. 2.1 Liquidity providers. Who fuels the market? Central banks, by setting interest rates and intervening in crises, for example, Swiss National Bank's 2015 removal of the euro to Swiss franc cap, central banks inject or withdraw liquidity. Commercial banks, as primary market makers, banks quote bid/ask prices and profit from spreads. The interbank market, where banks trade with each other, sets benchmark rates like LIBOR. ECNs and brokerage firms, platforms like MetaTrader aggregate liquidity from multiple sources, enabling retail traders to access competitive pricing. High-frequency trading, HFT, firms, algorithms execute trades in milliseconds, contributing to market depth and narrow spreads. 2.2 How market makers operate. Market makers, for example, brokers, profit by spreads, charging the difference between bid and ask prices. Internalization, offsetting client trades internally rather than routing them to the interbank market. Hedging, using derivatives to mitigate exposure to large client positions. However, conflicts of interest arise when brokers act as counterparties to client trades, incentivizing practices like stop-loss hunting. 2.3 The impact of electronic trading. The rise of algorithmic trading and ECNs has democratized access to liquidity. Retail traders now compete with institutions, narrowing spreads and improving execution speeds. For example, the shift from phone-based trading to platforms like CTrader reduced spreads for euro to US dollar from 3 pips in the 1990s to 0.1 pips today. 3. Benefits of high liquidity in Forex trading. 3.1 Reduced transaction costs. Tight spreads. In liquid markets, spreads for euro to US dollar can be as low as 0.1 pips, translating to 1 per 100,000 traded. Exotic pairs, however, often have spreads exceeding 5 pips, costing $50 per trade. Lower commissions. ECN brokers charge commissions based on volume, which are offset by tighter spreads and liquid pairs. Case study: a scalper executing 50 trades daily on euro to US dollar saves $500 daily compared to trading US dollar to Swedish krona, where spreads are 5 pips. 3.2 Minimized slippage. Slippage, the difference between expected and executed prices, is rare in liquid markets due to abundant orders. However, during black swan events, for example, Brexit referendum, liquidity evaporates, causing slippage. Example: in January 2015, the Swiss National Bank's abrupt removal of the euro to Swiss franc cap caused slippage of over 1,000 pips, bankrupting brokers and traders. 3.3 Enhanced price stability. Liquid markets absorb large orders without drastic price changes. For instance, a $10 million trade in euro to US dollar may move prices by 0.5 pips, while the same trade in USD/TRY could trigger a 50 pip swing. 3.4 Improved strategy execution. Scalping relies on tiny price movements, impossible without tight spreads. News trading, liquidity ensures orders are filled during high volatility events like non-farm payrolls releases. Algorithmic trading requires deep order books to execute complex strategies without market impact. 4. Risks of low liquidity and how to mitigate them. 4.1 Volatility and slippage. The liquid markets are prone to gaps and exaggerated moves. For example, the pound sterling to US dollar flash crash in October 2016 saw a 6% plunge in minutes, triggered by algorithmic selling amid thin liquidity. Mitigation. Avoid trading during off hours, for example, Asian session for euro pairs. Use guaranteed stop-loss orders, GSLOs, to cap slippage. 4.2 Wider spreads and hidden costs. Brokers widen spreads to offset risk in illiquid conditions. A trader entering USD/ZAR during a liquidity drought might pay 20 pips instead of 5, eroding profits. Mitigation. Trade major pairs during peak hours, London-New York overlap. Monitor economic calendars for high-impact events. 4.3 Execution delays and requotes. In thin markets, orders may be delayed or requoted, repriced, particularly for large positions. Case study: a trader attempting to short USD/TRY during a 2018 liquidity crunch faced repeated requotes, missing entry points. 5. Liquidity across trading sessions. 5.1 Session-specific liquidity dynamics. Asian session, Tokyo/Sydney focus on JPY, AUD, and NZD pairs. Lower volatility but stable ranges. London session accounts for 35% of daily volume, with high liquidity in Euro, GBP, and CHF. New York session overlaps with London, driving peak liquidity in USD pairs. Weekends and holidays, liquidity dries up, increasing gap risks. 5.2 Tactical trading based on session timing. Scalpers target the London-New York overlap for tight spreads. Swing traders enter positions during quieter sessions to avoid noise. 6. Case studies, liquidity crises and lessons learned. 6.1 The 2015 Swiss franc crisis. The SNB's sudden removal of the euro to Swiss franc floor caused liquidity to vanish, leading to broker insolvencies and trader losses. Key takeaway: diversify across liquid assets. 6.2 Brexit and the GBP Flash Crash. Thin post-referendum liquidity amplified GBP's plunge. Lesson: avoid holding positions during high-risk events. 6.3 COVID-19 market turmoil, 2020. The USD spiked as investors fled to safety, causing liquidity mismatches in exotic pairs. Central bank swap lines stabilized markets. 7. Strategies to navigate liquidity conditions. 7.1 Adapting to high liquidity environments. Exploit narrow spreads with high-frequency strategies. Use volume-based indicators, for example, VWAP, to confirm trends. 7.2 Surviving low liquidity conditions. Reduce position sizes to manage risk. Avoid exotic pairs during off hours. Hedge with correlated liquid instruments, for example, trading gold as a USD hedge. 7.3 Tools for monitoring liquidity. Economic calendars, track events like central bank meetings. Depth of market, DOM visualize order book liquidity. Volatility indexes, CBOE's FXVIX measures Forex volatility. 8. The future of liquidity in Forex. Cryptocurrency influence, stablecoins like USDT could bridge Forex and crypto liquidity. Regulatory changes, MiFID II and Basel III reforms impact bank liquidity provision. AI and machine learning, predictive algorithms may anticipate liquidity shifts. 9. Conclusion. Liquidity is the cornerstone of Forex trading success, enabling cost-effective execution, stable prices, and strategic flexibility. While low liquidity presents risks, informed traders can navigate these challenges through session timing, risk management, and instrument selection. As the Forex market evolves with technology and regulation, understanding liquidity dynamics will remain essential for long-term profitability. In a realm where milliseconds and pips dictate outcomes, liquidity is not just an advantage, it is a necessity. Please like and subscribe.